Hello everybody, my name's Zach and welcome back to the Financial Strength Project. Today we're going to be comparing the differences between buying stocks and buying real estate. So without further ado, let's jump in. Now, I'm sure you've heard the age-old Australian proverb, yeah, nah mate, you can't go wrong with real estate. But depending on your investment strategy and what you're trying to do, one of these asset classes might be better suited towards you. Before we get into this though, I'm going to ask you to smash that like button, hit that subscribe button, and make sure you click on the bell so that you get notified whenever we upload our weekly video. So first off, let's talk about stocks, the pros and the cons. Our first pro will be little to no barrier to entry. Buying stocks is super easy and requires very little capital to start. These days with technology, you can literally just go to the Play Store or the Apple Store, download one of the many applications on your phone, transfer some money over into an account, and you're on your way. Diversification. Did you know there's over 2,000 companies listed on the ASX and over 3,000 companies listed on the US stock exchange? This means you're able to invest into almost any industry that you can think of. This could include retail, mining, banking, manufacturing, agriculture, construction, and the list goes on. This can be an important consideration when you're trying to grow your wealth and spread out your risk. High liquidity. Stocks and shares are traded on most days with the exceptions to things such as public holidays and the weekends. This means that if you go and invest $10,000 today and all of a sudden you have an emergency, it's quite possible that tomorrow you can pull that money out and use it for whatever you need. This therefore means that stocks are a liquid asset. Dividends. Some stocks offer something called a dividend. This is where a company will pay out part of its profit towards stock investors involved in their company. These can often be distributed quarterly, bi-yearly, or annually. Of course, this profit is to do with what you want, but dividend investors often reinvest them towards the stocks to grow bigger and bigger returns. Now, I know this sounds all good and dandy, but like anything, there's cons to this as well. Short-term volatility. The price of a stock can change dramatically in a very short period of time. Depending on your situation, this could be seen as a pro or a con. It could be detrimental to your return on investment if you needed to pull out your shares for whatever reason and the market is down. But however, when the market is down, this also provides with a perfect buying opportunity. And this leads on to our next point, emotional investing. Imagine that you've worked hard to earn your money and you invest it into a company. The next day, you check those stocks and the price per unit has dropped dramatically. How do you think you'll react to this? Will you take the approach of cutting your losses and pulling out now before it drops even further? Or will you be able to take a level-headed approach and ride this out until the price hopefully returns to where it was or possibly goes above that? This is what happens with investing in stocks, and depending on your appetite for risk will depend on your reaction to volatile markets. Buying and selling stocks is just as much a psychological game as it is being able to make the right buys and sells and stay invested in the market. Now, let's talk about real estate. Constant income. If you rent out a house that has a positive cash flow, it's very likely that you will earn a regular income off this. You will more than likely find this return is higher than what you'll get on dividends for owning stocks. Over time, this can be used to pay down the debt that is leveraged against the property that you've borrowed, or it can be used to reinvest into the market and to other opportunities. Physical asset. When you buy a property, it's something that you can touch, feel, and see in front of you, unlike a stock. This means that even if the property market goes down and crashes, you know that you still have something tangible that you could live in if you needed to. This is different to stocks. If a manager of a company that you own stocks in runs the company into the ground, it could send them bust, meaning your shares are worth nothing and they're literally just a piece of paper. Possibility for sweat equity. If you're a hands-on person and you're good with tools, you could renovate this property, which is going to add to the value. This is called sweat equity. From here, doing renovations, making improvements to gardens and other parts of the property, you could well and truly increase the value of the property and how much rent you can charge a tenant for this property. Taxable deductions. If you choose to rent out the property that you own, it opens up a whole nother level of tax deductions. Some of these may include advertising for tenants, body corporate fees and charges, council rates, water rates, land taxes, cleaning, gardening, pest control, insurance, property agent fees and commissions, property repairs and maintenance, and the list goes on. You can also claim any travel expenses such as fuel and vehicle hire for travel between your office and those rental properties. This would include things such as collecting rent and conducting housing inspections. I know this all sounds good, but there are also some cons you need to be aware of. Barrier to entry. The barrier to entry for investing in property can be a lengthy and difficult process. First, you'll need to find an appropriate property that suits what you're after. This will normally include negotiations with real estate agents, the person selling the property, solicitors, and the bank. You may also need to have a large amount of money put aside so that you can go and get a mortgage on this property, which of course is another form of debt that is leveraged against this property. Dealing with tenants. Not every tenant you meet is going to be a perfect human being, and sometimes things happen with tenants, such as damages to the property, water leaks, general property maintenance, they might not pay their rent on time. All these things could add up. And I'm sure you don't want to get that dreaded phone call in the middle of the night because a pipe has busted and is leaking through the house. Extra work. Depending on whether or not you have the money to pay a property manager, owning a rental can put a rather large strain on how much you need to work through the week. This could include things like picking up the rental money, dealing with maintenance, and other issues. So to wrap this one up, stocks and real estates have both their pros and cons. You'll have to think about how hands-on you want to be with your investment as well, and if you're in a position to take on debt and what sort of returns you're after. For me at the moment in life, I prefer a more passive approach, and because of this I'm solely invested in stocks and REITs. Now REITs stand for Real Estate Investment Trust and gives me exposure to the market. Although eventually I do believe I'll be involved in rental properties. As always guys, thank you very much for taking the time out to watch this video. Please don't forget to like and subscribe if you're interested in the channel. We'll post some links below to other forms of social media that we're on. And until the next one, stay safe guys. Thank you.